Hi, everyone. Why don't we give people a couple of more minutes to join up? We are expecting a reasonably large size crowd here, and then we can begin. Can everyone hear me? Okay, great. Thank you. Hello, everyone. I think we can get started now. Well, good evening and welcome to Credit in the New Reality Lessons from Around the World. My name is Shiv Chatterjee. My co founder Yuvraj and I are the joint managing directors of DMI. Thank you all for joining us today. To state the blindingly obvious, we are in unprecedented times. We have each learned more about pandemics and their propagation than we ever dreamed we would have to. And we are all sitting around the world in some mode of lockdown or the other, stronger in some places than others. In these times, India suffers from a couple of extra challenges. In keeping with the other EM economies, the quality of data in India is poor at the best of times. In a COVID-19 situation where the developed world is grappling with forecasting the future, how should we in India, especially those of us who are involved in the dissemination and transmission of credit, how should we think about the future of credit and the future of credit quality in India? What are the lessons from around the world that we can use to inform our view for the next several months and quarters? That's the goal that we want to achieve in this webinar. It came out of a bunch of internal conversations and some bilateral conversations with our partners. And to that end, I would like to introduce our head of economics and data, Chris Wiegand. Chris spent a few years at the Federal Reserve Board in Washington, D.C. Then he was a US economist at Citigroup North America for 8 years. Then he was head of all research for Soros Fund Management for 4 years. And for the last few years, Chris has been heading our economics and data effort at DMI. The way we are going to structure this is Chris is going to give the presentation. We expect that to last probably about 45 minutes, give or take. We will follow that up with a brief Q&A. You can submit your questions in using the Q&A button at the bottom of your screen, or you can raise your hand to speak. It's probably easier to submit the question in writing, but we will try to keep track of people who are raising their hands as well. On that note, let me hand over to Chris.
Thanks, Shiv, and good evening, everybody. Thank you for taking the time to join for what hopefully will be an informative presentation and Q&A here over the next, as Shiv said, 45 minutes to an hour. What I'm going to do is, as Shiv mentioned at a high level, is give a broad presentation on COVID and credit with a focus on a couple of areas. As Shiv said, there's much that we don't know, and we need to be humble and recognize that we are truly out of sample here, and that episodes of the past can provide some insight into the present situation and where we might be headed, but they need to all be treated with a grain of salt. So what I'm going to do here is review the overarching situation as it relates to the virus, and also communicate some early takeaways that relate to credit performance as economies have been shut down and as people have lost their jobs. There's going to be four main components to the presentation. We can classify them broadly as the following. First, a high-level review of the virus, its transmission, and how certain countries have dealt with the transmission of the virus, both initially, some successfully, some unsuccessfully, and then the second wave that is starting to emerge. And what implications can we take away from those experiences and relate them qualitatively to India? The second component will be to look at China. Stating the obvious, the virus began in China. China instituted a series of lockdowns and now is starting to reopen its economy. So we can look to China for some directional insight in terms of how long lockdowns need to take to get the virus down to a low transmission rate, and what economic activity and employment looks like when things start to reopen, again, directionally or qualitatively. Third component will be to take a look at early initial experience in credit performance in the United States. One of the wonderful things about the United States is that publicly traded companies have to report in detail trends that they see in their loan books. And with the large banks having just reported first quarter earnings, we have a lot of detail with respect to how credit is performing in the U.S. So we will review those. We will review those trends, and again, see what we can qualitatively take away from that might apply more broadly, including to India. And then lastly, we'll have some generalized takes about thinking about risk management and credit performance, and what credit supply and demand might look like on the other side of the lockdowns based on historical experience. So let me get started with some more substance. To summarize everything, the current pandemic is by far the most disruptive public health emergency we have seen in any of our lifetimes, and in all likelihood dating all the way back to the Spanish flu that followed World War I in 1918. Actions that have been taken globally to try to slow the spread of the virus are, in a word, completely unprecedented. There's 90% of the world's economy at any given point in time has been completely shuttered, something that has never happened. Even in the depths of world wars, we've never seen this type of sudden stop in economic activity on the scope that we are currently seeing. Now, this sudden stop is going to have implications for individuals and businesses, for their ability and their willingness to pay their credit obligations. It's likely to have implications for people's willingness to take on debt in the future. We will examine the evidence to date, as I mentioned in my overview, and we'll draw some initial conclusions as to what we think the landscape is likely to look like once the pandemic peaks and we get to the other side. As I mentioned, we're going to start with transmission. There's a lot we don't know. This is a novel pathogen, and as such, we are in uncharted territory. But there also are some things that we have learned, that epidemiologists have learned. And I think there are some reasonable conclusions that even non-physicians, non-epidemiologists can draw about the virus and what it might mean in terms of thinking about economic activity and credit performance going forward. So what we do know, without any shadow of doubt at this point, is that transmission of COVID-19 happens extremely easily. The epidemics and pandemics of the past 100 years have been varied in their transmission mechanism and their ultimate disruption to economic activity. SARS, back in 2003, was initially thought to be transmitted highly easily. Turns out that it actually was very difficult to transmit in the grand scheme of things, because it could only be transmitted when symptoms were present. The Hong Kong flu in 1968, which was a very disruptive pandemic, was much more contagious than SARS and resulted in more than 1 million deaths around the world. And of course, the most contagious pathogen that we have seen in the past 100 or so years was the Spanish flu of 1918 that decimated the world and had multiple waves to it. This current episode, COVID-19, is without a doubt the most contagious pathogen since the Spanish flu of 1918. Will it be more contagious? Impossible to say. We won't know that until after the fact. But there is no doubt that it is extraordinarily contagious, and that is the reason that we have seen these lockdowns in countries around almost the entire world. So far, scientists have no firm consensus on the life cycle of the virus. And by that, I mean, how long can it live in the air? How long can it live on a surface, such as a counter or the subway? We just don't know that yet. It seems to be the case that the virus's active life is longer than originally understood. This is one reason that the scientific community believes that the spread of the virus has been so fast in densely populated areas with mass transit systems. In addition to the close quarters, such as we see in parts of China or in New York City, there's a growing consensus that it seems to be the case that the virus is able to live on surfaces. So as someone takes the subway, not only are they in close contact to someone else by being breathed on, coughed on, sneezed upon, but it's also the case that by simply holding on to the railing in the subway for those standing and then possibly touching their face, that the virus is able to transmit that way. This multifaceted ability to transmit the virus is likely contributing to the high degree of contagion and naturally makes it challenging to snuff out. Consistent with the rapid transmission we've seen in places like New York City and certain densely populated areas in China, it seems little doubt that densely populated areas are more at risk of widespread transmission and rapid transmission than less densely populated areas. Simple fact of life of being in close proximity to other people. The virus is somewhat unique in the sense that the major disruptive pathogens of the past 100 years have had a pretty narrow range of outcomes. With the Spanish flu, for instance, if you contracted the Spanish flu, you got sick. You knew you were sick, and more people than not recovered. But you definitely showed symptoms, and there were some people who unfortunately passed away. With this virus, the outcomes range from absolutely no symptoms to death. And the lack of symptoms, again, being somewhat repetitive, makes this virus difficult to contain because there could be large parts of the population that are spreading the virus and have no idea that they have it. Hence, governments around the world's decisions to move to lockdown. You know, we do know a few things based on US and European hospitals where people have been treated and have passed away in terms of who is most susceptible to the virus. It tends to be those with pre-existing healthcare conditions, those who are obese, those who have some sort of heart ailment, be it high blood pressure, be it high cholesterol, and some that have pre-existing lung conditions. We also know, at least statistically, based on limited data, that men seem to be at greater risk of severe complications, including death, than women. Why it's too early to say. But when you take these facts about who is experiencing the most severe complications, including death, and one clear takeaway is that those people who are suffering the most and who seem the most at risk are coming from parts of the population that tend to be poor / lower income. And as a general rule of thumb, such individuals tend to have less access to healthcare, tend to be less healthy than the population on average. So when you apply this to developing countries, including India, it does mean that there is a heightened risk that should the virus start to circulate broadly in the population, that the death rate and or severe complications rate of patients could be quite high. Here I have a couple of simple graphs to show how rapid the virus can spread, and also why it has spread as fast as it has, as quickly as it has. So if we look on the graph on the left, these are cases reported by China during what is effectively the first month from early January to early February of the virus circulating, reported outside China, of the virus circulating from early January to early February of the virus circulating around the world. As you can see, it's a linear pattern with the number of cases increasing by about the same degree each day from early Jan to early Feb. But when you add another month to the time horizon and then look at cases from early Jan until early March, you see that ultimately the exponential growth rate kicked in. And of course, if you extend this even further out, we're now at approaching 3 million cases outside of China, not just 42,000 as shown in the graph, as the power of compounding has continued. And if we hadn't had these lockdowns around the world, the slope up would be even steeper than what we see here. Again, restating a point that's made before, but one that's, essential to hammer home, left unchecked, because there is no immunity to this virus and its rapid rate of transmission, you see phenomenally rapid growth, i.e. exponential growth, throughout the population of this virus. What we also know now is that social distancing, i.e. lockdowns, to be more blunt about it, is absolutely effective at slowing the infection rate. We can look at 2 European countries here on these graphs, both Italy on the left-hand side and Spain on the right-hand side. What these graphs are showing is the so-called R0 rate, or R0 rate, which is the scientific shorthand for the rate of infection. In other words, a person is infecting how many other people, a person who has the virus is infecting how many other people. So for instance, an R0 rate of 5 means that if I have the virus, I am infecting 5 other people. And then those 5 other people who have been infected infect another 5 other people each. A high R0 rate means that you have very rapid exponential transmission, and a low R0 rate means that you're slowing the transmission of the virus. So if we look at both Italy and Spain here, these calculations show that from early February until late February, early March, which were periods that were before each country moved to lock down their economies and the movement of people, you saw a phenomenally rapid increase in the rate of transmission. But since measures have been put in place to keep people at home, to keep people apart from each other, you've seen that the rate of transmission has slowed steadily. It's taken, excuse me, it's taken almost 2 months. Excuse me. It's taken almost 2 months to make a notable improvement. But what you can see from these two countries, and if you look at data in other countries also, is that the rate of transmission from social distancing / lockdowns is slowing and slowing rapidly. So in other words, these measures do work at slowing infection rates. These measures, for what it's worth, date all the way back to the 1300s. One of the pandemics of the 14th century was where physicians, such as they were at the time, came up with the idea of social distancing, and that the only way to slow a rapid rate of spread of a new virus was to keep people as far apart as possible. 800 years later, 700 years later, we're still relying upon the same type of methodology, but it does work. But social distancing in and of itself, as we'll talk about in a minute, is probably not enough. What's much more effective is social distancing plus aggressive contact tracing. And we can see that in Korea. Korea is, and to a lesser extent Hong Kong, both suffered initial outbreaks. Korea's initial outbreak was much larger than Hong Kong. At one point in late February, the R0 in Korea was roughly 5. Yet through an aggressive contact tracing program, plus social distancing and aggressive quarantine by the authorities of those who have come into contact with others who are COVID-19 positive, you can see that there's been a very steep decline in the rate of spread of the virus in Korea. Indeed, the rate of spread the R0 is now below 1, which is the necessary threshold for the virus to ultimately be eradicated. So Korea provides a template for how other countries can most effectively stamp out the virus. Unfortunately, Korea is about the only country in the world that has combined aggressive social distancing and aggressive contact tracing right out of the bat. And so they are ahead of others, but there's much to learn from them in the period ahead from their success. So what about second wave risks? This is, of course, the concern should be the concern for everyone as lockdowns end and the economies around the world start to reopen. Unfortunately, there are signs of second wave risks as infections are rising in certain countries. This is a potentially very troubling development because it raises a possibility that we could have sort of starts and stops that roll throughout the rest of 2020 in terms of social distancing and lockdown. Singapore probably provides the best example here. Singapore, because of its position in Asia, has historical experience with dealing with novel pathogens, SARS, MERS, swine flu, etc. It knew like Korea, it knew what to do, which was lock down the country, limit the inflow of people from around the world, and at the same time, implement an aggressive contact tracing and quarantine system. It did that. And as we'll see in a minute with some data, it was successful at preventing a wide spread rate of infection. However, Japan did a similar type of initiative initially and is now seeing a second wave, and the same thing with the Chinese. But if we look here on the left, we can see that as Singapore has reopened in late March, as they started to allow people to return to schools, as they started to allow economic activity to restart, the number of confirmed cases in Singapore went from very low to increasingly moving in the exponential pattern that we've seen in other countries. The chart on the right looks at just fatalities in Japan, but if you look at the same confirmed cases, it also shows a similar pattern. So to put it, to restate it and to put it bluntly, these countries which had experience in dealing with novel pathogens did the right thing early on. They had success early on, but as they're now trying to reopen their economy and people are circulating in general population, what we're seeing is because of the high rate of transmission, there's an acceleration in the rate of spread. And again, beating the same theme, this is a troubling development because it raises a possibility of periods of start-stop and makes it very difficult for countries to reopen, potentially very difficult for countries to reopen on a sustained basis. So what are some takeaways for India? I mean, I've mentioned some of them in passing, but let's summarize them here. India has high population density, especially in places like Mumbai, has low income areas, and it has limited access to healthcare for some large segments of its population. All of those make India vulnerable to the rapid spread of the infection. Nonetheless, the official data show that the level of infections, both in absolute terms and on a per capita terms, are quite low. India's rate of infection, confirmed positives are only about 20,000, and confirmed deaths as of last night were 682. So in a country with more than 1 billion people, those are extraordinarily low rates on a per capita basis. It's probably the case that the scope of India's lockdown is helping to contain the spread of the virus so far, and in turn the fatality rate. Google has been tracking mobility in various parts of economies, various different sectors of economies around the world. You can go to the Google URL that's listed here, or just go to Google and type in COVID-19 mobility. And you can see that India, on quantitative measures, has one of the most stringent lockdowns. It's my judgment, not being a physician, but my judgment as a social scientist, that that the degree of this lockdown is certainly helping contain the virus. The big test will be when mobility restrictions are lifted. As we've seen in Singapore, as we've seen in Japan, that once restrictions are lifted, because there's no herd immunity, and Tokyo is a densely populated area, Singapore is a densely populated area, then in densely populated areas that the virus starts to resurface. So, that's probably a too long overview on the virus, but I think it's very important to understand the second wave risks, and that just because lockdowns are lifted, that we should not assume that life is going back to normal, or that there will not be additional lockdowns that governments decide to impose later in time to try to re-slow the spread of the virus. So let's turn to the Chinese experience. China was the locale of the virus in Wuhan. They instituted lockdowns, albeit belatedly, but they instituted lockdowns to try and slow the spread of infection, which has been mostly successful. And what can we take away from them? What lessons or experience that they had can we apply to the rest of the world? So the first thing is that the Chinese were reactive rather than proactive. They allowed the virus to circulate knowingly for 6 to 8 weeks before locking down. Wuhan was the epicenter, and the Wuhan lockdown was extraordinarily tight, far tighter than what is generally understood by at least reported by the press. It's not an exaggeration to say that apartment buildings with high infection rates were closed by the authorities, and people were prevented from getting out. Despite extraordinarily aggressive lockdowns and restrictions in Wuhan. It took 10 full weeks to turn the rate of infection spread from exponential growth to exponential decay. That is an R naught below 1. So that extraordinarily tight lockdown that took 10 full weeks is a reasonable blueprint for the rest of the world to think about in a stringent social distancing setting. How long does it take to get the virus's rate of spread down to a level where policymakers and government officials have reasonable confidence that they can start to reopen things? In much of the world, lockdowns didn't start until mid-March. So if we apply the Wuhan framework, that implies at best maybe a second half of May or early June opening. Again, applying that framework, which will be relevant for some countries and not relevant for some other countries. Now that we're about 14 weeks past the initial lockdown in China and about a month past from when lockdown started and about 4 weeks past from when lockdowns started to be eased up, we can look and see what's happened in the Chinese economy and use that to draw some potential conclusions for what's going to happen elsewhere. It is a fact that China's economy has started to recover. However, it is very gradual, it is very tentative, and it is not anywhere near as vigorous as what is being reported by official economic statistics or what the Chinese government is producing in terms of news flow and, dare I say, propaganda about how fast they're bouncing back. The majority of businesses have reopened. So office buildings are reopened, factories are reopened, restaurants are reopened, movie theaters are reopened, but business is far, far from back to normal. And what you're seeing on the ground is that those types of businesses that require close personal interactions and are discretionary in nature continue to have very little business. So movie theaters are, for all practical purposes, continue to be empty. Air travel and train travel continues to be a fraction of what it was before. And restaurants for dining in also continues to be at a fraction of what it was before. To put a broad number on it, as we'll look at here in some charts, things are maybe 75% back to normal at this point. So here are a couple charts that underscore the recovery, and again, provide some templates to think about how the rest of the world will recover once lockdowns end. These two charts show different measures of movements of people and goods. And what you can take away from these is that any way you slice it, the pickup, such as it is, in traffic and movement of people via public transportation, following China's Lunar New Year Spring Festival, or comparisons to the same point in time last year, is extraordinarily muted. People are just simply not returning to normal, in part, again, because the economy is only sort of partially back online, but also in part because behavior is changing. There's no herd immunity in China, just like there's no herd immunity anywhere else. And so as a result, there's a hesitation to go out unless one needs to go out. And I think this is a lesson that will apply globally in the period ahead. One way to put a little bit of quantitative numbers grounding to the recovery in economic activity is to look at something that's called the Wiegand index. So Wiegand is a part of Tencent. Tencent is China's largest mobile payments, has China's largest mobile payment system via its WeChat application. And pretty much all transactions that are B2C transactions for less than $100 US equivalent in China happen via the WeChat app. And so it provides a very good sense of what the broad level of economic activity is in China. And you can, see here, from the start of the Lunar New Year, that relative to last year, that the recovery in WeChat transactions, WeBank transactions, is still about 20% below where it was a year ago, and is still running at a fraction of what, quote unquote normal would look like. So again, this gives you a little bit of quantitative grounding to think about how, as economies around the world, and India included, start to open up, what the level of activity might look like. Let's turn now to U.S. credit performance, and what we're learning, what we're seeing, and what we can take away from there. So the four largest banks in the United States, JP Morgan, Bank of America, Citi, and Wells Fargo, last week reported their first quarter earnings. And because public companies in the United States have to report a large level of detail about their earnings, and banks have to report a large level of detail about their loan performance, we have some initial, albeit, again, initial and tentative insight into how credit is performing as the U.S. economy has been locked down. And repeating a familiar theme, I think there are some qualitative takeaways that we can take from these data and apply to around the world to how credit may perform in other countries, India included. In short, the data that have been provided by the big four U.S. banks are worrisome. Now, the lockdown in the United States started in mid-March, like how it did in much of the rest of the world. So Q1 earnings from these banks really only covered between 15 and 18 days of a sudden stop in economic activity. And these banks also reported last week, so they had about another 10 to 12 days in April where they could compile and share some qualitative assessment. So we have 2 to 4 weeks of information on credit performance in the U.S. at the largest banks to help inform what's going on in real time in the United States and what that might mean on a broader basis. What's potentially troubling, and again, emphasis on the word potentially, is that the rate of, or the credit performance to date at some of the banks is far worse than one should expect given the short duration of the slowdown so far. If we look at, I'll come back to this, I know I'm jumping around a little bit, but if we look at what Bank of America has reported, Bank of America reported that they had more than 1 million of their clients either seeking forbearance on loans and or not making their latest loan payment, whether it is an auto loan, a credit card loan, a mortgage. This period encompassed from May 15th until April 10th. And the median FICO score of the clients at Bank of America that were either seeking forbearance and or not making their latest payment was 700. That's a solidly prime FICO score. It's not ultra prime, but it is nowhere close to subprime. Consumers with these type of FICO scores, with a median FICO score of 700, should not be under sufficient economic distress that they need to seek forbearance and or are unable to make payments just 2 to 4 weeks into a sudden stop in economic activity. So very sobering development. Again, because unemployment, while it has gone up, it has just started to go up. And these are strong borrowers from a credit worthiness perspective. And historically, across many cycles, dating back to the 1980s, borrowers with this type of FICO score don't miss payments or don't seek help on payments this early in an economic contraction. It could simply be that people are scared, worried about the future, distracted, trying to take advantage of the government allowing and encouraging banks to make forbearance for certain type of loans. But again, the numbers are sufficiently large at just Bank of America alone that it suggests that there's potentially something more insidious at work. And so it's something that needs to be monitored very closely in any sort of lending portfolio. Similarly, Ally, which is a smaller bank and whose clients tend to be bottom part of the prime credit score, upper portion of the subprime credit score. They have a profile similar to Capital One, which may be a name that's more familiar to those listening in. They reported 25% of their auto loan clients have asked for payment deferrals. And of those clients who asked for payment deferrals, 75% have never asked for a deferral before and 70% have never been late. Now, Ally is, a subprime, lower prime lender, but they tend to have long-standing relationships with their client base because, like Capital One does, because they serve a certain niche. And these numbers, again, in my judgment, are far higher than one would have expected given the short duration of the economic interruption. And so these types of data points this early suggest a bright red warning flag to me about the possibility of credit losses. What makes this even more troubling, and I don't want to sound too alarmist, but what makes this even more troubling is that the US economy has entered this in the best position it has been in terms of unemployment and consumer balance sheets in many, many decades. Debt in the US has been relatively low in the consumer sector. Interest rates are low, allowing for low debt service relative to income. And defaults have been, pretty much non-existent. Consistent with that, banks have had very low level of funds reserved for losses, understandably so, because the unemployment rate was at a 50-year low. And so to see this type of distress this early in an economy that was doing well sends off all sorts of alarming signals. Now, of course, we're going to need more data, like in anything. But to me, this is a major cautionary flag for credit performance around the world. Again, recognizing the need for new data. So let's turn to the last sort of component, and I'll move a little bit quicker here in the interest of time, so we can get to any questions that there might be. What are some generalized takeaways that we can think about, that have applicability to, India and to people's businesses potentially? So, first off, as I've, said explicitly and implicitly multiple times, the current experience is totally out of sample. We don't have a historical precedent that we can use to model this. Models are very useful for helping ground expectations. But when you're this far out of sample, it's very hard to rely on models for risk management purposes to help inform your judgment about what your losses might be, what things might look like. So that's something that we need to keep in mind. One thing that is also very important to keep in mind, related to that out of sample nature, is that in normal business cycles, and by normal business cycles, I mean one where you have a sort of endogenous or self-inflicted downturn because the economy has gotten over its skis. There's been too much spending, too much debt taken on. Government makes a mistake and raises interest rates too high. In those normal business cycles, there is a very stable relationship between unemployment and financial distress. Unemployment's a good shorthand for thinking about ability for creditors to, for debitors to pay back their creditors. And you can build relatively straightforward models where you plug in assumption for a change in unemployment, and you get a pretty good estimate for the change in the NPA. In fact, if we skip ahead here, this is the U.S. Relationship between the unemployment rate and the delinquency rate on all loans. So auto loans, student loans, housing loans, etc., going back from 1996 to the present. And, what you see is, in simple terms, if the unemployment rate goes up 100 basis points, the delinquency rate goes up 100 basis points. The unemployment rate goes down 100 basis points, the delinquency rate goes down 100 basis points. So it's a nice, simple, reduced form model that gives you a lot of confidence. If you're going to say unemployment's going to 5, then you can kind of model out your NPA expectations. But what happens in sudden stop type environments is that linear relationship oftentimes becomes unstable and breaks down. When one goes and looks back at some of the sudden stops that happened in emerging markets in the 1980s and 1990s, ranging from Latin America in the early 80s to Asia in the late 1990s, when you see a full-on sudden stop of economic activity and the unemployment rate as your proxy for financial stress moves in a step function type way, that sort of nice tight relationship between the delta in unemployment and the delta in NPAs, breaks down, and it becomes a regime model where at different thresholds, different levels of unemployment imply different ratios of the rise in NPAs. And so it's too early to know whether that's going to be the case now, like everything, but I think a reasonable deduction based on, again, limited data that we're seeing in the United States is that that's probably the case in the current episode in the US, and it's probably going to be the case elsewhere. Last comment, everything that I just said about sort of challenges related to modeling out NPAs in a period that's out of sample and a sudden stop, you can take all of that and magnify it for those borrowers who are further down the credit quality spectrum. Marginal credits are always most at risk. There's nothing unique about that statement. They're always the most financially vulnerable to income losses, job losses, disruptions in their daily life. And oftentimes, they've typically obtained credit via a non-traditional or alternative lender and via non-traditional employment, income, and creditworthiness documentation. And this certainly applies to paint in a very, very broad brush stroke to parts of the non-bank financial company sector in India, and even to the traditional banking sector in India. So there definitely is additional risk because of that, and we can see that to some extent in simple terms if one just looks at the subprime mortgage episode of the U.S. around the financial crisis. So subprime mortgage delinquencies from before the financial crisis, we're running at about 10%, which is about where they've historically run in the U.S. And once the financial crisis hit and there started to be severe distress, both from a combination of the terms of the loans plus rises in unemployment, you saw that you went from moderate distress in subprime mortgage credit to extraordinary stress in subprime mortgage credit, with the delinquency rate approaching 30%. It ultimately peaked at 28%. And unemployment, that distress was multiples of that suggested by the traditional unemployment rate, or even a broader measure of the unemployment rate. And so the point being is, those that are more marginal borrowers in periods of severe distress, are likely to have a sort of nonlinear NPA behavior to them relative, to more normal periods of distress. In India, to make, again, very high level, some very high level tentative conclusions. There's definitely going to be some risk to NPAs being higher than what many people would imagine. Partly it goes to that credit penetration is growing rapidly in India via the fintech business. The longer the disruption goes on, the worse for credit performance. But ultimately, NPAs will depend on the underwriting standards, the idiosyncratic nature of the borrower, and other micro factors. One last point that's worth making here to think about potential scale of NPAs. So I walked through the U.S. subprime experience, but the Greece experience is also one that's worthwhile. Greece had a depression in a period from 2010 through about 2016. Unemployment in Greece was above 20% for five full years. And NPAs in Greece ultimately reached more than 40%. And they were consistently above 25% from 2012 to 2016. Now, important to point out that in Greece, NPAs didn't immediately go to 43%, the worst level they reached, but it took them, about 4 to 5 years to get there. But they ran from 25, and then they went to 28, then they went to 33. And so they rose each year at sort of an accelerating rate. Now, those were truly depressionary type environment that persisted in Greece, and one that hopefully will not persist anywhere around the world. But again, it gives a broad outline or broad framework to think about what a severe and prolonged period of economic distress can do to NPAs. Ultimately, NPAs will be a function of, as I mentioned, idiosyncratic factors. One thing to keep in mind is that history shows that loan portfolios that have a relatively short duration tend to perform much better in these type of environments than loan portfolios that have a longer duration. The reason is very straightforward. Normally, it takes borrowers 6 months, 12 months, 18 months, 24 months to decide that their economic prospects have shifted, that they are actively not going to pay loans anymore, or that they run out of money. The one potential flag here in this current episode is a large number of borrowers in the US who already are seeking forbearance. So we're in uncharted territory here, but I think the assumption that one should make is to, prepare for the worst, prepare for the possibility that economic disruptions are larger than what you are generally thinking now, and that the corresponding implications to credit performance is likely to be generally worse than what you expect. But again, every loan portfolio has its own idiosyncratic nature, and is subject to factors that are also very micro-based rather than macro-based. Last point, and I'll stop talking, is one thing that may be a long-lasting byproduct of this crisis, and I emphasize, maybe, is that you may see a slower rate of credit demand on the other side of this. Two qualitative examples that are worth mentioning. One is the United States, obviously very advanced economy with a lot of, with broad credit penetration already, advanced financial system, etc. But one of the byproducts of the financial distress that came out of the 2008-2009 recession was that away from mortgages, that the rate of growth in credit, the demand for credit, has been much more muted than it was on average in the period before the 2008-9 recession. And in China, again, small sample, but what we've seen since the lockdowns took place is that short-term lending, most of which happens through smartphone apps, like through Alipay, through Tencent, through Panchon, through Noah, which are all leading Chinese companies at providing short-term credit to the consumer sector. What we've seen on the other side of this is a sharp collapse in the rate of growth and demand for credit. Now that just may simply be that there's been a lockdown. It may also be like how we've seen on a longer trend basis in the US, that there's a more cautious attitude following a period of financial distress, a more cautious attitude toward taking on debt, and instead a more muted pace of spending growth. Too soon to say, but something that's worth worth thinking about from a business perspective on a medium-term basis going forward. So I've talked more than enough. Let me stop there, and Shiv, turn it back over to you.
Thanks, Chris. That was great. We'll now go into a Q&A session, and what I recommend is that just so that we can handle things fairly and answer questions in the order in which we receive them, just type them into the Q&A box if you have them. So starting with Tushar Mendirata, question is, with China's rapid test checking, anyway, the question seems to be that since China has a lot more tests happening, India's numbers may be higher and not getting captured.
Yeah, I think that's right. So I mean, so I think that's exactly right. That's likely, but that's not just an India, specific thing. I think the reality is that, based on some studies that have already been done in the US and Europe, is that the virus is circulating through a much larger percentage of the population than what testing is capturing. How large, we have no idea. Again, playing amateur epidemiologist, I strongly suspect that's the case in India too. The one thing, we're sort of reliant only upon the actual data that we have, but I think that's a very reasonable, conclusion.
Okay. The next question is from Karthik Venkatraman. Is there a parallel between COVID and the Great Depression? Mary Meeker and Bond Capital suggested that the drop in economic activity / unemployment rates now seems similar to the 1930s.
So yes, I think that's yes. The answer is yes, but there's some nuance around it that will vary country by country. The scale of economic contraction, the rise in unemployment are looking, very similar to the Great Depression. What is different in some countries is that, unlike the Great Depression, where you had economic policy that was on balance contractionary and served to make unemployment go even higher and economic distress become even more severe, what you're seeing in a lot of countries is the opposite, where governments are trying to provide support to individuals, to businesses, and the like. So that is an important difference. The other key issue in the Depression was you had massive bank failures globally. And with the banks going down and the banks being the entire provider of credit to the entire economy and financial system, it just became very hard to restart. In this episode, the health of banks and finance companies varies massively around the world. But having just lived through the financial crisis and recognizing that banks have to be alive and have to be able to extend credit, or finance companies have to be alive and have to be able to extend credit, governments, broadly speaking, understand that. And so that's a important counterweight to a prolonged depression. In other words, we've learned a lot of things from that period, and we're applying them.
Sure. The next question is a little bit outside your particular expertise, I think, but just in case you want to take a stab at it, it's from Other Say It. Is pandemic insurance available?
So, so the short answer is no. In the United States, let me speak to that. There is a lot of business interruption insurance, but for the most part, those policies have explicit exclusions for pandemics. And there's actually sort of brewing lawsuits, especially among restaurants in the United States and the insurance sector, where restaurants are trying to say that their business interruption policy should play out. But acts of God, such as pandemics, are typically excluded from normal insurance policies. If you want protection from an act of God, there are insurance companies that underwrite them, and you pay a price for it.
The next question comes from Kapil Maheshwari and requires, and he's asking us to quantify some of these things that we are speaking qualitatively of. How much do you expect the default spread to increase over the risk-free rate in the home loan, loan against property, and the small and medium enterprise loan book in India?
Yeah, so I think the answer to those is that much more work needs to be done. The goal of this presentation was to pull together some initial emphasis on initial conclusions that we see from around the world, and get that information on the table and communicate it to people. And then the really hard part, is to think about how to start to try to quantify those with ranges.
From Amit Arora, what is the early delinquency situation in China post-COVID lockdown?
Good question, and I meant to actually touch on that. In the interest of time, skipped it. So Chinese data are extraordinarily limited, as we know, and you can't believe the macro data anyway. What we do know from more micro anecdotal situations is that we're seeing, and these are very round numbers based on anecdotes from specific non-bank financial companies that I know, that you're seeing non-performing assets basically move from something that is in the high teens to 2 times that. So 15 to 20% to 30 to 40%. Now, Chinese government has been very explicit that that lenders, whether they're state-owned or not state-owned, need to provide forbearance and cannot pursue collections. So it's not quite like the moratorium that's in India. In China, they're encouraging people who can pay to pay, but at the same time saying, well, you don't have to pay because the lender is not going to come after you. So I'm not sure, it's hard to draw a conclusion and say that, NPAs have really doubled. But again, as a starting point for thinking about what might happen, that provides you some grounding directionally.
Another one from Other Say It. Is there a correlation between government spending as a percent of GDP and unemployment rate and NPAs?
No. What there might be a correlation in this current episode is between the rate of government spending that provides support to businesses to explicitly keep people employed and NPAs. In other words, those governments that pursue spending policies where the government is using its balance sheet to pay small businesses employee salaries, and therefore those employees maintain recurring income and therefore can pay their debt obligations, there's likely going to be some positive relationship there. But in a broader level, no.
Question from Sandeep Srinivas. So most examples of unemployment-related NPA in Greece/US is a consequence of fundamental problems in the economy. However, the current NPA is a consequence of lockdown, which is artificial in nature. In the context of that, do you see a faster recovery from a high NPA percentage?
It's an excellent question, and one that I'm going to make no bones about, sidestepping answering. The answer is I don't know. It's going to really depend on the speed at which we can get back, to work. And it's just very hard to have visibility around that. I know that's not a direct answer, but that's the best answer I can give.
We have a few questions about whether the slides will be shared. Unfortunately, no, the slides will not be shared, but we are recording this session and we will at some point shortly after this make the recording available. We have a question from Ashish Singhal. In India in 2008, we saw the home loan portfolio behave better compared to the unsecured loans. This may have been due to greater affinity of the consumers towards the house. Do you believe this will change and the lower tenor, largely unsecured loans perform better this time around?
It's a question that needs some additional, let's try that again. It's a question that requires some additional thought. Again, I like to give direct answers, but it's one that needs additional thought, and not trying to avoid your question. I'm just not sure at this early stage. It needs more thought and work.
We have a question from Ashish about increase in NPA levels in the unsecured lending ecosystem. I think we've addressed that largely. We have a question from Pankaj Sabu. How do you think Indian MSMEs will fare through this crisis, given that their delinquency rate has been lower than corporate borrowers up until now?
So, I'm going to repeat something I've said, which may be a dissatisfying answer. Depth and duration, will of the lockdown will be important. Is to make a big broad statement. Indian, SMEs like SMEs, globally tend to be more thinly capitalized, tend to be, have thinner margins than businesses at large, and so by default are more sensitive to severe disruptions in economic activity. A key thing is going to be what's the government policy support that's provided for the sector. I can't speak in intelligent terms to India, per se, what the Indian government will do. I don't think anybody knows for sure. To the extent that there's policy support for those type of entities, then the better the NPA outcome will be.
Yuvraj,
the policy support so far is not what it needs to be. To be clear.
Yuvraj, did you want to say something on this question?
No, it's okay. I'll defer to Chris, but I would like to thank Chris for taking the time to speak with us and providing his valuable insights. It's a real privilege to have you on board. Thanks a lot for your time, Chris, especially during this difficult period.
Yeah, no, of course. Welcome.
We have a question from Tushar Agarwal. How would you plot the NPAs in India compared to the US? Could you share some data on the NPA net of recovery in the US once the crisis was over? So what are recovery rates in the US like after the credit crisis?
Sure. So recovery rates vary massively depending on the loan. One thing that is in the U.S. is there's recourse loans and there's non-recourse loans. So and not surprisingly, the recovery between non-recourse and recourse varies. So let's talk about things like credit card loans and personal loans, since those are probably most applicable to India. So recovery rates, tend to be about, range from kind of 30% to 60%, depending on the credit quality of the borrower. Low quality borrowers tend to be at the bottom end, not surprisingly, and higher quality borrowers tend to be at the top end. I don't think an average or a median is necessarily all that useful, but think about it as subprime borrowers at 30, borrowers that kind of straddle the subprime prime metric were at about 40 to 42, and then your prime borrowers were at around 58, 59, 60.
We have a question from Ranjit Mishra, which I think we have answered in part. India recently started lending a lot to new to credit customers across all segments, including affordable housing. What is your view on lending to these barefoot entrepreneurs in these unprecedented, uncertain times and their bleak future prospects? I think you
Yeah.
responded. It depends on the
I think we covered that.
Another question from Tushar Agarwal. With governments printing money globally, would this likely kick the can down the road?
So my view is no. I'm skeptical of that. Certainly, the government's printing money, both on the fiscal side and on the monetary side, is explicitly designed to provide a bridge to the other side here. And in some countries, those policies that are being done will be more effective than in other countries. But there's going to be losses. This is the steepest economic contraction, even if it only lasts for 4 months, that we have seen since the Great Depression. It is going to see the largest spike in unemployment that we have seen since the Great Depression. There is going to be severe financial stress. There is already severe financial stress. And so, the government's actions are mitigating factors. In some sense, they're trying to be bridge loans to, get, economies and businesses and consumers to the other side of this. But there's going to be large losses. That's going to be a fact. That's going to be a fact of life in this situation. If we didn't have these supports, things would be much worse.
Right. Question from Leonard Chettiar. How long do you estimate it will take for the economy to revive in India?
Yeah, again, I hate, not, giving definitive, or informed judge, at least, clear answers. I think it's very hard to know. The China experience, is a good blueprint. Here we are, 4 months back, 3 to 4 months after the initial, from day one of the lockdown, and they're at 75%, back. And that's in an authoritarian economy where state-owned enterprises are a pretty decent sized portion of the economy. So sure, the banks in India are, run by the state, and, the state has some roles in other parts of the economy. But, in a country like, India, if we apply the China, framework loosely, I would say, at the 4 month mark, you'll be, from the lockdown. So that's March 15th, let's call it mid-July. I would say that if you're back at 75 to 80% of what you were on March 1st, that would be a win. I would expect it to be, lower than that.
Given the number of questions and whatever time constraint we choose to put on ourselves, I am going to try to go with people who are first-time questioners, and also go with questions that have hopefully a more closed form answer than open-ended. This next one is from Shinab Dhar. Do you foresee hyperinflation as a result of massive money printing by central banks, given the low economic activity?
No, this is a deflationary impulse.
Question from Shrestha Karmakar. Reason for loans going down can be twofold. From the demand side, where people are spending only on essentials due to cash flow instability, due to job losses, and from the supply side, where banks are worried about collections due to cash flow instability of their customers. Seems like a vicious circle. Is there a way to break this circle?
That's an excellent question. That's an excellent point. The way to break it is, so the way to break it varies depending on the supply side or the demand side. On the demand side, it tends to be a function of confidence and about the future. On the supply side, the way to break it tends to be capital. More capital in the in the lenders, whether that capital is privately raised or whether it's forced in by the government. But the answer historically on the supply side has been more capital.
I have a question here from Raj Bikram Nair, which may be a little more detailed about the working of the Indian government and the Indian Central Bank that you might be prepared to answer at this point. But given that we had central banks post the 2008 crisis, deciding to follow a quantitative easing zero interest rate policy by acquiring subprime toxic assets initially and then printing capital and artificially inflating the equity markets, for example, in the US from 2009 to 2019, et cetera. Will India follow post-COVID a similar policy, in your opinion, which central banks in the West and Japan have been following? Evidence is the recent liquidity announcements related to CRR, MSF, and so on.
Yeah, so I would defer to Pramod, DMI's chief Indian economist on thoughts on that, and maybe we can follow up with a question or after the fact.
Sure. Do you have an opinion? This is from Adhip Ramesh. Do you have an opinion on which sectors in the small businesses will rebound quicker than others, and who will provide credit to the ones who are on the verge of going down?
Sure. So I have an opinion on who will struggle to respond or struggle to recover, and those are those are the type of sectors that require people in close contact. So restaurants is your kind of an excellent one. To answer the question more directly, I think technology. As economies open, there's still going to be a strong penchant for work from home. And so those firms that supply some sort of technological support, some sort of cloud solution or work from home solution or anything that allows for remote work or ease of communication, those type of entities are likely to thrive for some period of time.
Question from Vipul Beniwal. Do you have an opinion or any guidance you'd like to provide on USD versus EM currencies?
I was going to say I'm going to sidestep that, but let me make one comment. So in periods of crisis, the US dollar tends to do well, and we've seen that so far. And I would say that that's likely going to continue to be the case, largely because the US dollar is liquid and the US Treasury market is very deep and near infinite in size. And so people who are looking for safety can buy short-dated US Treasuries, and that should support the dollar. Let's leave it at that. And the other thing, let me make one more point. The other thing is, EM countries, to draw with a very broad brush, so far, in terms of reported infection rates, reported fatality rates, have fared better, in terms of, the virus transmission and the like. Now, whether that's under-reporting, whether, that's some other factor, who knows? But one, I think reasonable assumption is that at some point, the virus will be, set aside the economic disruptions, but the virus will spread through EM countries and could create problems, later down the road.
Question from Mukund Venkatesh. In subprime, near prime retail credit in the UK, supply has contracted significantly, but so has demand. Any commentary about the US and how similar retail credit players are looking in the next 1, 3, or 6 months?
Sure. So, Citibank is the largest sort of single provider of credit to the type of entities that you just mentioned. They were pretty careful in terms of what they reported and what they said last week when they talked about their earnings and their forward-looking metrics. But on balance, they talked about that they would continue to be there for their, for their clients. So I think in the United States at this point, there's still a willingness to supply credit. Now, part of that is, that, the banks got bailed out in '08 and '09, and, they can't be seen totally acting in their own self-interest here. They need to be seen acting in, sort of the, the better good, at least early on. If 12 months from now, we're still having this conversation about economies being shut down, that's a different story. But for the next, 1, 2, 3, let's call it till September. I think that, what I passed along from Citi's comments are probably, the right way to think about it.
How do you see the interest rate regime in the medium to long term? Is it going to stay low, or do you think we see a recovery back to more normal?
So I think it's going to stay low, but that would have been my assessment, before this, in the sense that, the factors that have driven, interest rates relatively low, in terms of excess savings, and aging demographics in the developed world, which doesn't necessarily apply to the emerging world, had contributed to, low interest rates, and globally as it was. So even absent of, this pandemic, it was my view that interest rates were likely to remain relatively low. Certainly for the next 2 years, interest rates are going to be extraordinarily low, in my judgment. But I think then, as you reassert the longer term fundamentals and fundamental forces, they're still what they were. One thing that we can take away from other major pandemics, which again, are limited in nature, they kind of can be borne down to the '68 Hong Kong flu and the 1918 Spanish flu, is that, the world ultimately recovers from this, and gets back to normal. What we just don't know in real time with any precision is how long that takes. And so what existed, on the front side of this is ultimately going to exist on the back side of this. But if that's in 6 months or if that's in 2 years, impossible to say, because we don't know how long it will take for a vaccine, if one can be developed, how long it will take for herd immunity, how long it will take for therapeutics, what government officials will do to try to get back to normal. So these are all, unknowns. But I would reemphasize that, prior things like this, we get back to normal, and what normal looked like on the front end is what, normal at 100,000 foot level looks like on the other side. We just don't know how long it'll take to get there.
We have a few questions on credit demand, so I'm just going to amalgamate all of them. You answered this, but maybe you want to elaborate a little bit. Do you see a crash in credit demand?
No, I don't see a crash in credit demand at all. And again, let's think just kind of qualitatively about sudden stops and lots of other prior. Let's think about lots of other prior sudden stops, which haven't happened for a long time, but they used to happen pretty regularly in emerging markets in the 80s and 90s, and the devastation that would wreak. And you would see a period of muted credit demand afterwards, and but it's not a crash. It's just a more cautious attitude toward taking on risk, because when you see all of your income or revenue go away, you naturally become more cautious for some period of time. So no, I don't see a crash, but I do think what's highly likely is a more muted period of demand for some period of time.
Great. I think that covers the Q&A session. There are other questions here, but many of them have already been covered, and some of these are outside the scope of this webinar, so I'm just not going to touch them at this point. Thank you very much, Chris. Thank you, everybody, for attending. We really appreciate you taking the time. These are testing times, and as Chris said, we're going to come out of it on the other side, and the recovery is going to look pretty much what it looked like going in. We just don't know how long. So Everybody stay safe, stay healthy, please.
Thanks, everybody.
Thanks, Chris.
Manish, can you handle the